Introduction to futures. Futures form the core of derivatives markets. All commodity derivatives exchanges facilitate futures instruments as part of their offering. As discussed in earlier videos, a futures contract is a legally binding agreement between the buyer and the seller, entered on an exchange to buy or sell a specified amount of an asset at a certain time in the future for a price agreed today. The buyer enters into an obligation to buy and the seller is obliged to sell on the specific date. Futures are standardized in terms of size, quantity, grade, and time, so that each contract traded on the exchange has the same specification. In this series of videos, we will learn the basics of commodity futures, the terminology, futures pricing, some basic futures trades, and much more. Topics: 1. Types of futures, individual commodities and indices. 2. Futures contract terminologies and definitions. 3. Taking positions in futures contracts. 4. Payoff charts. 5. Payoff charts for futures. 6. Position changes in futures, adding, reducing and square off. 7. Mark to market or MTM. 8. Open interest. 9. Rollovers. 10. Pricing of futures. 11. Cash settlement and delivery settlement. 12. Delivery settlement mechanism. 13. Types of futures trades, hedging. 14. Types of futures trades, speculation. 15. Types of futures trades, spread trading. 16. Types of futures trades, arbitrage. In our video lessons, we will use numerous examples of commodity futures to explain profit and loss calculations. While we will choose real contracts as examples, the prices of these contracts will not be the real prices on the MCX. We will create price data that makes it easier for us to understand the concepts. So, let's get started.